The part of buying a car that most people spend the least time preparing for is the part that costs them the most money, and it is not the sticker price. It is everything that happens after the price is agreed. In the room at the back of the dealership, where a finance manager presents products in a specific sequence designed to extract maximum money from someone who has already made the decision to buy and just wants to be done. There are exactly 4 ways people finance cars that work against them in 2026, and the most expensive one is the one almost nobody talks about because it looks the most responsible. And before we get into the 4, there is one thing worth understanding about how the dealership's financing business actually works, because understanding it changes what happens in every subsequent conversation. A car dealership makes less money on the car than most people assume. The margins on the vehicle itself are thin. The margin on the financing is not. When a dealer offers you a loan, they are not passing through a rate from a bank. They are marking up a rate from a bank. The bank offers the dealer a rate called the buy rate, and the dealer is legally permitted to charge you anything above that rate and keep the difference. On a $35,000 loan at 7% versus a 5% buy rate, the dealer collects the equivalent of approximately $1,500 in additional interest income from you without your knowledge. And without it appearing anywhere on the contract as a separate charge. It is embedded in the payment, and the payment looks like just the loan. This is the business the finance office is actually running, and the 4 mistakes below are the 4 ways buyers fund that business without knowing they are doing it.
Mistake 1, accepting the dealer's interest rate without shopping. Most buyers enter the finance office having negotiated the car price carefully and accepting the financing terms without any equivalent preparation while the buyer is. So the dealer's finance manager is the best prepared person in the room for that conversation, while the buyer is the least prepared. The protection is pre-approval, arriving at the dealership with a pre-approved rate from your bank or credit union before any conversation about financing begins. A credit union in 2026 is offering rates between 5.5 and 7% on new vehicles for buyers with strong credit. If the dealer can beat that rate genuinely, the buyer benefits. If they cannot, the buyer has the pre-approval as leverage and as a fallback. The pre-approval takes 1 online application and approximately 24 hours. It costs nothing, and it converts the financing conversation from a presentation the dealer controls to a comparison the buyer controls. Every car financing expert and every consumer advocate says the same thing about this step, and almost nobody does it before they walk onto the lot.
Mistake 2, agreeing to the monthly payment instead of the total cost. The finance office works in monthly payment terms, not in total cost terms, and that framing is not accidental. It is the mechanism that allows significant additional costs to be added to a transaction without the buyer experiencing them as significant. A $50 monthly increase on a 72-month loan is $3,600 added to the total cost of the car. And in the context of a monthly payment conversation, $50 feels like almost nothing. The protection is to reframe every conversation to total cost. Not what is the monthly payment, but what is the total amount I will pay, including all interest over the full loan term. And this reframe does 2 things simultaneously. It removes the dealer's ability to hide cost increases inside payment adjustments, and it forces a comparison between the total financed cost and the cost of alternatives, including a shorter loan term, a larger down payment, or a different vehicle. The buyer who negotiates in total cost is operating in a different transaction than the buyer who negotiates in monthly payment. Same dealership, same room, different outcome. And if the rate markup mechanism and the monthly payment framing just changed what you thought you understood about car financing, the like button is right there. It means this video keeps reaching people before they need the information, rather than after they paid the price for not having it. Mistake 3, buying the finance office's add-on products. The finance manager is not a financial advisor. They're a salesperson with a specific product line, and the products presented in the finance office are presented in a specific sequence for a reason. The lower-cost products arrive first to establish a pattern of yes, and the most expensive products arrive after several agreements have been made. This is the sequence the finance office is trained to run, and most buyers experience it as just being helpful. The specific products to decline by default are extended warranties. These are available from the manufacturer or third parties after the purchase for less money. credit life and disability insurance, this is almost always more expensive than equivalent coverage available independently. Guaranteed asset protection, or gap insurance, this is sometimes genuinely useful, but is available through your own insurer for significantly less. And paint and fabric protection packages. These add nothing that the car does not already have and are among the highest margin products in the finance office. The correct posture at the finance desk is to decline all add-on products by default and request time to research independently any product that sounds genuinely useful. A legitimate product will still be available in 3 days. A high-pressure close is a reliable signal of a bad product.
Mistake 4, the one that looks the most responsible. Most financial advice about car buying treats cash as automatically superior. And for many people in many situations, cash is the correct choice. But in 2026, there is a specific scenario where financing is the mathematically correct decision for someone who has the cash available. And the mistake is not understanding that scenario and paying cash when financing would have been better. The scenario is this: if you qualify for a rate below the return available from a safe investment, and in 2026, high-yield savings accounts pay between 4 and 5%, while credit unions offer promotional rates below 3% on select vehicles, then the cash you would have paid for the car earns more invested than the interest costs you. On $30,000 at 4.5% annual return over a 4-year loan at 2.9%, the invested cash outperforms the interest cost by approximately $2,200. The responsible-looking mistake is paying cash when the math favors financing. And the math favors financing specifically when the rate is below what the cash could safely earn elsewhere. This is the mistake that looks like wisdom and costs real money. The decision framework that covers all 4 mistakes is this: know your credit score before you visit a dealership. Get pre-approved before any conversation about financing begins. Negotiate the price separately from the financing begins. Decline all add-on products at the desk and research them independently. And calculate total cost, not monthly payment, for every option presented. The finance office at a car dealership is one of the most carefully designed revenue processes in retail, and most buyers walk into it with less preparation than they spent researching the car, which is why the car price they negotiated so carefully matters less than most of them realize once the paperwork begins. The part of buying a car that costs you the most money is not the part you prepared for. It is the 45 minutes after the price is agreed. And now you know what to do with every one of those 45 minutes. I make these videos because I find it genuinely unreasonable that the most profitable part of a car transaction is the part the buyer walks into least prepared. Subscribe so I can keep being unreasonable about that on your behalf. The video on your screen right now might be more helpful for you, so click and watch.